Welcome to Book Summary Podcast, your gateway to personal transformation. Each episode delivers big ideas from the world's most impactful books on mindset, productivity, and success, all in just a few minutes. Ready to turn knowledge into action? Let's get started.
Welcome to the deep dive. We've got quite a stack of fascinating sources here today, and we're going to really dig into the psychology of money, some of those surprising forces behind financial success and failure.
Exactly. Our mission for this deep dive is to try and unpack the key insights from all this material, help you cut through some of the noise, and maybe, just maybe, shift how you think about money outcomes.
Yeah, because we're going to get into some, frankly, pretty wild stories and ideas, things that explain why we all do kind of crazy things with our money sometimes.
Right. And maybe why nobody is actually crazy. They just, see the world through a different lens based on their own experiences.
It's less about finding the one right answer, more about understanding the messy human side of it all.
Precisely.
Okay, let's unpack this. So right off the bat, the material hits us with this incredible contrast. Ronald Read, the janitor, and Richard Fiscone, the Harvard-educated finance exec. It's almost like a fable.
It really is. You've got Reed, humble background, works as a janitor, gas station attendant, passes away, leaves millions to charity, quietly amassed this fortune.
Right. And then Fiscone, Harvard MBA, Merrill Lynch, Crane's 40 under 40, retires early in his huge mansion.
And then the 2008 crisis hits. He's over-leveraged, loses absolutely everything, homes foreclosed, the works.
It just flies in the face of what you'd expect, doesn't it? The pedigree versus the patience.
That's exactly what the sources zeroes in on. It wasn't the education or experience gap that was the deciding factor in the long run. It was things like Reed's incredible patience versus perhaps Fiscone's eventual greed or impatience taking on too much risk.
Reed just kept saving and investing decade after decade. Simple, but powerful.
And that story really opens the door to this fundamental idea in the material. Outcomes aren't purely skill or effort. Luck and risk are always there, like inseparable twins.
Which is uncomfortable, right? We like to think we're fully in control. We see success and attribute it all to hard work.
Absolutely. Take Bill Gates, obviously a genius, incredible drive. But the sources point out that 1 in a million luck factor.
Him going to Lakeside School in 1968, one of the only high schools in the world with a computer terminal then.
Yeah, exactly. He and Paul Allen got thousands of hours of practice and learning when almost nobody else could. Gates himself admits Microsoft probably wouldn't exist without that access.
But then there's the flip side, the risk. Kent Evans.
Ah, yeah. Gates' best friend at Lakeside. Just as smart, just as passionate about computers. They were planning big things together.
And he died in a mountaineering accident before graduating high school. All that potential, skill, ambition, wiped out by sheer unpredictable risk.
It really underscores that luck and risk are two sides of the same coin.
And it's hard to talk about, isn't it? Pointing out someone else's luck sounds like sour grapes. Admitting your own luck can feel like you're downplaying your own hard work.
Which makes learning the real lessons so difficult. The sources mentioned that study by Bhaskar Mazumdar.
About brothers' incomes being highly correlated.
Exactly. More correlated than height or weight, largely because of shared background and opportunity, which is a form of luck.
But those successful brothers probably don't attribute much to luck themselves. We see the Forbes covers celebrating investors, maybe some were lucky, but we never see the stories of people who made sensible choices but just got hit by bad luck.
Right. It's tough to model success when a key ingredient, luck, is invisible, or we pretend it isn't there.
Which flows perfectly into the next big idea, how our unique experiences literally shape our view of money. People do things that look crazy from the outside.
But nobody is crazy. They're just operating based on the lessons their own specific life has taught them. It's like everyone has a unique money fingerprint.
That reframing feels really important. Instead of judging someone's choice, asking what might they have experienced to make that seem like the right move.
Exactly. Think about it. Different generations, different parents with totally different money habits, different economic conditions growing up. High inflation versus stable prices, booming job market versus recession.
All those things carve different lessons into your brain.
And what you personally live through is just infinitely more powerful, more convincing than anything you read in a book or hear about secondhand. It sticks with you.
Like someone whose family lost everything in the Great Depression is going to view debt and risk fundamentally differently than someone who came of age in the booming 90s tech bubble.
Or think about people in countries that experienced hyperinflation versus those who haven't. Cash looks very different. Australians who went decades without a recession versus Americans who see them more regularly.
The material makes this wild point. Your personal experiences make up maybe 0.0000001% of what's happened in the world, but they probably form like 80% of how you think the world works.
Wow. Yeah, that really puts it in perspective.
So when you see these smart, informed people arguing fiercely about, say, the future of interest rates or whether stocks are overvalued,
It's often not that one is smarter than the other. They're just processing the same data through completely different lenses, shaped by different equally valid life experiences.
which makes giving one-size-fits-all financial advice almost impossible, doesn't it? What's rational to me might look insane to you just based on our histories.
Exactly. Your rational is built on your reality.
And adding another layer here, the sources point out just how new so many of the financial tools and concepts we take for granted actually are. We're kind of all beginners at this modern finance game.
This part was genuinely eye-opening for me in the material. The whole concept of retirement as this expected phase of life where you stop working and live comfortably.
Barely 2 generations old, before World War II, most people just worked until they died or couldn't physically continue.
And Social Security, when it started, the benefits were tiny. The idea that it could provide a substantial income or keep most seniors out of poverty, that really only became the reality in the, late 60s, maybe even the 80s, for decent benefit levels.
Yeah, and that widespread belief that everyone used to have a great pension. The sources suggest that's kind of a myth, too. Like in 1975, only about a quarter of seniors had any pension income, and it wasn't usually a huge amount.
And the whole system we have now, where the expectation is that you, individually, are responsible for saving and investing your own money for retirement. That's incredibly recent.
The 401k was born in 1978. The Roth IRA, 1998. It's barely old enough to legally drink.
Huh. Right. So if you feel like you're just winging it sometimes, trying to figure out how much to save, where to invest, what enough even looks like, well, there's a reason.
As a society, we're relatively new at this. We don't have centuries of accumulated wisdom passed down like we do for, say, farming or building.
Think about other recent shifts, too. Widespread college access is post-WWII. The explosion in tuition costs, more recent. Student loans becoming a major societal issue. The last couple of decades, index funds are less than 50 years old. Hedge funds is a big force, maybe 25 years. Even widespread consumer credit, like credit cards and car loans, really took off after the war.
So yeah, we're navigating a financial landscape that's fundamentally different and in many ways more complex than what previous generations faced. Feeling like a novice is actually pretty accurate historically.
We're all just learning as we go, in a way.
Okay, so let's pivot a bit. We've talked about getting money, shaping views. What about keeping it? The sources make this really stark point. Getting wealthy might have many paths, but staying wealthy, that boils down to, essentially, frugality and paranoia.
Such a powerful framing, isn't it? And those parallel stories of Jesse Livermore and Abraham Jermansky during the 1929 crash really drive it home.
Yeah, Livermore, the trading legend, makes an absolute fortune shorting the crash, goes home that day, family's terrified, they're ruined, but he's actually one of the richest people on Earth.
Incredible timing, incredible skill at getting rich.
Meanwhile, Jermansky, the real estate developer who'd bet heavily on the boom, wiped out, disappears, presumably ruined and desperate.
But here's the kicker, the tragic twist. Livermore, the genius trader, couldn't keep it. He eventually lost everything in later years, took his own life. Juransky was ruined instantly.
Both were masters at accumulation, but terrible at preservation. They lacked that survival instinct when it came to wealth.
And this isn't just a cautionary tale for billionaires. The sources stress this applies to everyone. Getting money and keeping money are two distinct skills.
And the key word for the second skill, for long-term success.
Survival. Just plain survival.
Because you have to stick around. The material cites stats like, 40% of public companies eventually lose almost all their value. And the Forbes 400 list turns over significantly every decade. Failure is more common than we think.
Exactly. You need to endure the downturns, the unexpected hits. There's that Nassim Taleb quote again, something like, having an edge and surviving are different. The first requires the second. You need to avoid ruin at all costs.
Survival is the bedrock. Without it, no amount of genius matters in the long run.
And the reason survival is so critical is because it allows the most powerful force in finance to work its magic. Compounding.
Ah, yes, compounding. The eighth wonder of the world, supposedly, but something our brains seem really bad at grasping intuitively.
The Ice Age example in the material is fantastic for illustrating this. It wasn't one massive snowfall. It was a tiny, almost imperceptible change in the Earth's tilt, leading to slightly more snow sticking around each summer than melting.
Over tens of thousands of years.
That tiny, persistent surplus builds mile-thick ice sheets. It's not the size of the gain each year, it's the duration, the fact that the snow lasts.
And applied to finance, the Warren Buffett example is just staggering. Like $84.2 billion of his $84.5 billion net worth came after his 50th birthday.
And something like $81.5 billion after he qualified for Social Security.
It blows your mind.
It proves the point perfectly. Yes, he's a brilliant investor, but his real secret weapon, being a pretty good investor consistently for, what, 3/4 of a century?
If he'd started in his 30s like most people and retired in his 60s, he'd still be rich, sure, but we wouldn't know his name like we do.
Not even close. It was the time that allowed the compounding to become astronomical.
And the reason we struggle with this is our brains are wired for linear thinking, right? Like 8 plus 8 plus 8.
Exactly. But compounding is exponential. It's 8 times 8 times 8. Well, not quite, but you get the idea. It ramps up dramatically over time in a way that just doesn't feel intuitive.
Like that hard drive example. The progress was slow for decades, then exploded non-linearly. Even Bill Gates, brilliant guy, initially underestimated how much storage people would need for email because he was thinking more linearly.
So the takeaway for investing isn't necessarily to chase the absolute highest returns each year. Those are often fleeting or involve huge risks.
It's about finding pretty good returns that you can actually stick with, that you can tolerate for the longest possible time.
That's where the real magic happens. That's when compounding runs wild. Time is the key ingredient.
Okay, so if survival is essential to let compounding work over time, how do you actually increase your odds of survival? The sources talk about the value of room to run, a margin of safety.
Right. This is the practical side of the survival mindset. It's about making yourself financially unbreakable, or at least highly resilient, so you can withstand the inevitable shocks without being forced out of your long-term plan.
Like holding some cash, maybe more than seems optimal during a bull market, it feels like you're missing out, right? Your cash is earning nothing while stocks are soaring.
It feels conservative, even wrong sometimes. But that cash provides flexibility, options, the ability to withstand a job loss or unexpected expense without having to sell stocks at the worst possible time.
A plan has to survive contact with reality, and reality is messy and unpredictable. You need that buffer, that room for error.
And importantly, this isn't just about being timid or avoiding risk altogether. The sources frame margin of safety as something that actually increases your odds of success at a given level of risk.
How so?
By increasing your chances of staying in the game long enough for that risk to potentially pay off. It's about surviving the inevitable bumps along the road.
So it can take many forms, not just cash.
Oh, absolutely. It could be a frugal budget that leaves you with surplus cash flow. It could be flexible thinking about your career or income sources. It could be having a loose timeline for your financial goals, so you're not under pressure to hit a specific number by a specific date.
Anything that lets you live happily, or at least comfortably, with a range of possible outcomes, rather than needing one specific path to work out perfectly.
There's that interesting analogy in the material about brain development. How losing synaptic connections, which sounds like destruction, actually makes the brain more efficient and resilient long-term.
Right. Sometimes short-term inefficiencies or buffers build long-term strength.
And having that margin of safety implicitly acknowledges another key point. Failure is normal. You will make mistakes. You will be wrong sometimes. A buffer allows you to absorb those errors without being completely derailed. We really underestimate how often things go wrong, even for successful people and companies.
And that idea that failure is normal leads directly into why finance often seems so crazy, the concept that tails drive everything.
Yeah, this was a huge insight for me from the material. Tail events, those super rare outlier events, the 1 in 1,000 or 1 in a million shots, they often account for the vast majority of the results.
Like the Walt Disney example, his first studio went bankrupt. Many of his early films flopped or barely broke even.
But the massive success of a few huge hits, Snow White, later Disneyland, those were the tails that built the entire empire and paid for all the failures many times over.
You see it in venture capital too, right? The model is based on this.
Totally. Most VC investments fail or return very little. The entire fund's return often comes from just 1 or 2 massive home runs. The Googles, the Facebooks, the tails are literally everything.
And even in the broader stock market. That study of the Russell 3000 index.
It's astonishing. Something like 40% of all the stocks in the index since 1980 basically lost most of their value and never recovered. They were duds.
And effectively all the index's overall gains came from just a tiny fraction, like 7% of the companies that were massive outperformers, the extreme winners.
It tells you that failure, or at least mediocrity, is the norm for most individual stocks. The overall market goes up because the few huge winners pull the average way, way up.
So how does this apply to us as individuals navigating our finances?
Well, it means how you behave during those few extreme market moments. The crashes of '87, '08, or the crazy runs probably has a vastly bigger impact on your lifetime returns than all the years spent on cruise control.
Handling those moments of, as the source puts it, sheer terror is key.
Right. Sometimes being a genius investor just means you manage to avoid panicking and selling at the bottom, or getting wildly euphoric and greedy at the top when everyone else was losing their minds during a tail event.
It also explains why successful companies like Amazon or Netflix seem comfortable with failure.
Exactly. Bezos talking about the Fire Phone flop being a small price to pay for experimenting to find the next AWS. Reed Hastings worrying Netflix's success rate was too high, meaning they weren't taking enough risks to find those truly massive, game-changing hits the tails. They understand that you need lots of small failures to find the big wins.
It's like that Chris Rock analogy, testing hundreds of jokes in small clubs.
Most of which probably bomb.
To find the handful of killer jokes that make it into the Netflix special, we only see the successful tale, not the mountain of failed attempts behind it, which makes our own failures feel much worse than they perhaps should.
It all comes back to that George Soros quote. It's not about being right or wrong. It's about how much you make when you're right and how much you lose when you're wrong. You can be wrong often, but if your wins are big enough tails, you can still do very well.
Okay, given all this inherent uncertainty, risk, the importance of survival, the outsized impact of tails, what should we actually be aiming for with our money? The sources offer a really compelling answer. Using money to buy time.
This really resonated. The ultimate dividend money pays isn't more stuff, it's control over your own time. The ability to wake up and decide what you want to do, when you want to do it, who you want to do it with, for as long as you want. That's freedom.
And there's psychological research backing this up, right? That Angus Campbell work mentioned in the material.
Yeah, finding that a sense of control over one's life is a far more dependable driver of happiness than just income level or education or where you live. Autonomy is huge.
It makes me think of that anecdote about wanting to be an investment banker. The work itself might be fascinating. The pay, great.
But the lack of control, the brutal hours dictated by someone else, it can make even work you enjoy feel like a prison.
There's that psychological principle, reactance. We just fundamentally hate feeling controlled or forced to do things.
Exactly. Doing something you love on your own schedule feels liberating. Doing the exact same thing because you have to on someone else's clock can feel like pure drudgery.
The Derek Sivers story illustrates this perfectly, I think. He felt free when he quit his job at 22 with only $12,000 saved.
Right, because that was enough, living simply and gigging, to cover his basic needs and give him control over his time. Selling his company years later for millions didn't fundamentally increase that feeling of freedom as much as that initial leap did. Having enough to control your time was the key.
It highlights a potential paradox in modern wealth, doesn't it? We're richer than ever collectively. Bigger houses, more gadgets.
But are we happier? Studies suggest maybe not significantly more than, say, in the 1950s when material was lower, but maybe certain jobs offered more autonomy or community connection provided different satisfactions.
Maybe we've traded some control over our time for more stuff. Compare modern jobs to someone like John D. Rockefeller, whose primary work was thinking and making decisions, immense control over his time and energy.
That control, that autonomy, that's arguably the highest form of wealth.
And thinking about wealth, the sources draw this crucial distinction between being rich and being wealthy. They're not the same thing at all.
This is such a key insight. The irony is that true wealth is often invisible. We judge financial success by what we see, the fancy car, the huge house, the Instagram posts. Capitalism is great at helping people project an image.
Look rich even if you aren't.
Exactly. But wealth, as the material defines it, is the income not spent. It's the financial assets you haven't converted into visible stuff. It's the expensive car you didn't buy, the first-class upgrade you skipped, the diamonds left in the store.
It's the money working for you behind the scenes, not the money flashed around.
That Rihanna story, whether apocryphal or not, about suing her advisor for losing money, and the advisor basically saying, no, you spent it. It captures that difference brutally. Often the desire to be a millionaire is really the desire to spend $1 million.
Which is the fastest way not to be wealthy.
Precisely. So rich is about current income, high spending. You can afford the payments, you look the part. Wealth is hidden. It's savings and investments providing future options, flexibility, growth, and eventually that control over time.
The big problem, though, is role models, right?
Huge problem. It's incredibly easy to find rich role models. They're everywhere, showing off their spending. But finding wealthy role models, people quietly building assets through saving and investing, is almost impossible because their success is invisible by definition.
You don't see the disciplined saving, the skipped purchases, the compounding happening quietly in an index fund.
So we end up aspiring to the visible richness, even though deep down, what most people probably want is the freedom and security that comes with invisible wealth. It creates this tension, making it hard to learn the behaviors needed for wealth when all the signals point towards spending.
Like Ronald Reed, again, he only became a financial role model after his death revealed his hidden wealth. While alive, he was just the janitor. Nobody saw the wealthy man underneath.
It's a real challenge. How do you emulate something you can't see?
Okay, so if wealth is hidden and comes from not spending, and future investment returns are uncertain and largely out of our control, what is the most powerful lever we actually have?
The sources argue pretty strongly that it's your savings rate.
Simple as that.
Deceptively simple, maybe. Think about it. Investment returns, market timing, economic growth, those are all full of uncertainty. You can hope for good returns, you can try to position yourself well, but you can't guarantee them.
But your savings rate?
That's almost entirely within your control, right now and going forward. It's finance's version of efficiency or conservation.
Like that oil crisis example in the material. We didn't just solve it by finding more oil. A huge part was becoming dramatically more energy efficient.
Exactly. Cars, homes, factories, they all got way better at using less energy. The U.S. now uses something like 60% less energy per dollar of GDP than in 1950. Efficiency made a massive difference.
And saving is the financial equivalent. Focusing on increasing how much you save out of what you earn feels much more direct, more achievable than trying to consistently beat the market or predict the next big thing.
Compare the effort, too. Billions of dollars and countless hours spent by professionals trying to eke out a tiny fraction of extra return, often unsuccessfully.
Versus the potential to maybe boost your savings rate by several full percentage points just by making some conscious decisions about spending or avoiding lifestyle creep.
It shifts the focus from relying on external unpredictable factors to leveraging an internal controllable one. It puts you more in the driver's seat of your financial future.
Now, let's really lean into the human side. The sources make this fantastic point about aiming to be reasonable with money, not necessarily purely rational.
Yes, because as they say, you're not a spreadsheet, you're a person, a screwed-up emotional person. Trying to make decisions like a robot often fails because, well, we're not robots.
Being pretty reasonable is more realistic and, crucially, more sustainable over the long haul than striving for cold, hard rationality that ignores our actual human nature.
That absolutely wild story about Julius Wagner Jauregg curing syphilis with malaria.
Right. Technically rational based on his hunch that high fevers could kill the syphilis bacteria.
But injecting people with malaria. Completely crazy by normal standards. He won a Nobel Prize for it, but thank goodness penicillin came along later. It shows how far rational can sometimes be from sensible.
Or the more everyday example, fevers. Medically, a moderate fever can help fight infection. That's the rational view.
But what do we all do? Reach for the Tylenol or Advil almost immediately. Why?
Because fevers feel awful. They hurt. They make us miserable. And doctors, being reasonable, treat the patient's discomfort, not just the abstract biological optimum.
It's about finding a balance. Something can be technically true, but contextually nonsense for a real human being.
And this applies directly to finance. A strategy might look perfect on paper, mathematically optimal.
Like that Yale study suggesting young investors use 2-to-1 leverage to maximize long-term expected wealth. Rationally, maybe it makes sense in a spreadsheet world with perfect foresight.
But in reality, it's completely unreasonable. Imagine telling a normal person to stick with that plan after watching their leverage portfolio get wiped out in a 50% market crash.
They wouldn't. They'd panic, sell everything, maybe sue their advisor, and likely swear off investing forever. A rational plan you can't emotionally stick with is worse than useless.
So a reasonable plan is one that acknowledges your emotions, your potential for fear and regret. It's a plan you can actually live with and adhere to even when things get scary.
This helps explain why some seemingly irrational behaviors might actually be reasonable. like having own bias, investing more in your own country's market than diversification models suggest.
Rationally, maybe not optimal, but reasonably. Investing in what you know and feel familiar with can build trust and help you stay invested during global turmoil.
Or maybe dabbling in some individual stock picking, or even day trading with a small amount of money. Rationally, the odds are against you. But reasonably, if it scratches an itch for action and prevents you from tinkering with your main long-term boring portfolio, maybe it serves a purpose, like Josh Brown's perspective on this.
Even the story of Jack Bogle, Mr. Index Fund himself, investing some money in his son's actively managed higher fee funds.
Was that rational by his own investment philosophy? Probably not. Was it reasonable? Absolutely. As he apparently said, sometimes you do things for family. Life isn't always perfectly consistent. It's human.
Okay, let's talk about history. The sources use that great Scott Sagan quote, "Things that have never happened before happen all the time." Which is funny, because we rely so heavily on history to predict a future that constantly surprises us.
It's a real paradox, isn't it? The 20th century alone was just one unprecedented event after another. The Great Depression, world wars, nuclear weapons, the internet, major pandemics. Things nobody saw coming with that kind of impact.
And these events don't happen in isolation. They trigger cascades, often in completely unpredictable ways.
Like that chain reaction described. 9/11 leads to Fed rate cuts, which fuels the housing bubble, which leads to the 2008 financial crisis, which causes a terrible job market, which encourages more people to go to college, leading to the student debt crisis. You couldn't script that.
And the initial triggers for these huge events can be incredibly small, random things. A specific argument between Hitler's parents, Jonas Salk having a bad day, airport security finding one specific item, things you could never model or predict.
Mice eating the wiring insulation on German tanks before a battle. You can't plan for that kind of thing.
Yeah. Which brings us back to risk. The most dangerous risks are often not the ones you can quantify, but the unknown unknowns, the things too wild to even consider.
So how do you protect yourself against things you can't even imagine?
Not by trying to predict them, but by building in resilience and avoiding single points of failure, like redundant systems on airplanes or suspension bridges designed to withstand unexpected stresses.
And in personal finance. Saving money without a specific goal is a key way. It's not saving for a down payment or for retirement. It's saving because the future is uncertain and curveballs happen. It's a buffer against the unknown.
The sources argue the most important part of any financial plan is planning for the plan not to go according to plan.
Right. Build in that margin of safety. Assume future returns might be lower than historical averages, for example. Be prepared for things to go wrong.
Even Benjamin Graham, the icon of value investing, wasn't rigid. He kept changing his formulas and updated editions of his books because the world changed. He was looking for what works now, not what worked perfectly 20 years ago.
It highlights a nuance in using history. The further back you go, maybe the less relevant the specific economic conditions are today. Recent history might be better for tactical stuff.
But deep history
Is fantastic for understanding timeless human behavior, greed, fear, panic, euphoria. Our reactions under stress, those patterns repeat.
So it's a balancing act. Ignoring history is foolish, but assuming the future will perfectly mirror the past is also dangerous. That Michael Batnick quote about the most dangerous words, it captures the dilemma perfectly.
And speaking of timeless human behavior, the sources dig into our apparent bias towards bad news. That Deirdre McCloskey quote, "For reasons I have never understood, people like to hear that the world is going to hell."
Pessimism just seems to grab our attention more, doesn't it? It often sounds smarter, more sophisticated, more aware of risks. Optimism can come across as naive or blind.
But the sources distinguish between naive optimism and real optimism. Real optimism isn't believing everything will be perfect. It's believing that, despite setbacks and challenges, the odds of positive outcomes are generally in our favor over the long run.
Usually because most people, most of the time, are trying to solve problems and make things incrementally better, like Hans Rosling calling himself a very serious possibilist.
Yeah, I like that. Why is pessimism so pervasive, though? The material offers a few reasons. First, money is universal. Bad financial news affects almost everyone, so it gets instant, widespread attention.
Second, pessimism is often just a simple extrapolation of current negative trends. It's easy to assume things will keep getting worse in a straight line, ignoring our ability to adapt, innovate, and find solutions.
Like predicting we'd run out of oil based on trends before fracking technology completely changed the game. Linear thinking fails again.
And third, progress is usually slow, incremental, compounding quietly. It's hard to notice day to day. But setbacks, destruction, those are often fast, dramatic, and impossible to ignore.
Think about developing the airplane decades of slow, painstaking progress. Versus a plane crash, sudden, terrifying makes headlines instantly. Thomas Selfridge's crash got way more attention than the years of work before it.
Growth is slow. Destruction is fast. So pessimistic narratives have fresher, more dramatic ingredients readily available. Optimistic narratives require looking at longer, quieter arcs of history.
Understanding this bias is important. Knowing why bad news grabs you, how your personal history filters information, how rare events drive outcomes, it helps you avoid being overly swayed, maintain perspective, and crucially, avoid blindly following people who might be playing a very different financial game than you are.
And that brings us to maybe the most practical, actionable insight for anyone trying to build wealth over time. Understanding that investment returns aren't free. There's a price tag.
Exactly. And that price isn't just fees or commissions. It's volatility, fear, doubt, uncertainty, regret. Those are the emotional costs you have to pay to earn potential long-term market returns.
It's like buying anything valuable. You can pay the price, you can look for a discount, or you can try to steal it, which usually has bad consequences. Trying to get high returns without accepting the volatility is like trying to steal the car.
The sources use the Dow Jones example. Great long-term returns, yes, but look at how much time the index spent below its previous peaks. That chart showing the shaded areas, that's the time spent underwater. That's the price of admission.
And for higher growth, potentially higher return assets, like, say, tech stocks historically, the price is even higher. Stocks like Netflix or Monster Beverage apparently spent something like 94–95% of their time below their prior highs, even while delivering massive overall gains.
Wow. That really puts the day-to-day fluctuations in perspective. Higher potential returns come with a much higher emotional toll.
So you have choices. You can accept the price, embrace the volatility as part of the deal for potential long-term growth.
Or you can choose assets with lower expected returns, but also lower volatility, pay a smaller price. Like bonds, perhaps.
Or you can try to avoid the price altogether, maybe by trying to time the market or using complex strategies.
Which, ironically, often leads to paying double the price through mistakes, missed gains, and extra stress, like those examples of companies trying to smooth earnings to hide volatility from shareholders.
GE under Jack Welch, Fannie Mae, Freddie Mac.
Right. Trying to eliminate the appearance of volatility just meant the bill came due later, often much larger and more painfully. You can't escape the price forever.
A key reason people struggle with this, the sources suggest, is perspective. Volatility doesn't feel like a fee you willingly pay for something good, like buying a ticket to Disneyland for a fun day.
It feels like a fine, like you're being punished for doing something wrong when your investments go down.
Yeah.
And nobody likes paying fines. We naturally try to avoid them.
So the mental shift is crucial. Learning to view market downturns and volatility not as a fine for bad decisions, but as the expected necessary fee for the opportunity to earn long-term returns.
It doesn't mean it won't hurt. It will. And there are no guarantees. But if you frame it as the cost of admission, you're much more likely to be able to pay it and stay invested. If you see it as a fine, you'll probably panic and make costly mistakes.
Find the price of the returns you're aiming for, understand it, and be prepared to pay it.
Which leads perfectly into the final major theme from the material, knowing what game you are playing, and just as importantly, ignoring the noise created by people playing different games.
This feels like it ties so many of the previous points together, different experiences, different time horizons, different goals.
Exactly. Bubbles often inflate, and crashes often happen when people with different objectives start taking cues from each other without realizing it. Long-term investors get caught up in the frenzy driven by short-term speculators.
Like the dot-com bubble example, a stock like Yahoo, trading at insane multiples, might have made 0 sense for a value investor planning to hold for 20 years.
But it made perfect sense for a day trader who just needed the stock to go up a bit today or this week. The record trading volumes back then showed that short-term players were dominating and setting prices.
Same thing with the housing bubble more recently. Paying $700 for a tiny bungalow made no sense if you were a family planning to live there for decades.
But if you were a flipper planning to sell it for $750K in 6 months, it looked like a rational bet based on their game.
The real danger comes when you, playing your long-term game, start making decisions based on the actions or prices being set by people playing a completely different short-term game. You don't know their motivations, their time frame, their risk tolerance.
And this isn't just about investing. It applies massively to spending and social comparison too. So much consumer spending is driven by watching others, trying to keep up.
But we only see their visible spending, the richness. We don't see their income, their debt, their savings rate, their goals, their worries, the hidden wealth part or lack thereof.
Like the lawyer who feels they need an expensive car and watch to project a certain image for their career game. That spending might be, in a way, a business expense for them.
But if you're, say, a software developer working remotely who doesn't need that image and you start mimicking the lawyer's spending just because you admire their success, you're playing their game without their reasons or maybe even their income. It leads to stretching yourself thin.
The absolute key takeaway here is figure out what game you are playing. What is your time horizon? What are your goals? And then ruthlessly ignore the actions and opinions of people who are clearly playing a different game.
The author mentioning writing down a personal investment mission statement seems helpful here.
Yeah, like their example. I'm a passive investor, optimistic about world growth, confident over a 30-plus year horizon. Writing that down instantly clarifies what information is relevant, long-term trends, diversification, and what's just noise. This year's market forecast, next quarter's recession predictions, those are for players of different games.
Wow. Okay. That was quite the journey through the material you shared. We've really unpacked this often tangled, emotional, and yeah, sometimes baffling world of money.
We really have, from luck and risk being intertwined, to how our personal histories create our unique money views, and why feeling like a newbie in finance is actually pretty normal given how recent much of it is.
We hit on why survival is maybe the most underrated skill, the incredible quiet power of compounding over decades, and the need for a margin of safety to ensure you stay in the game long enough for that compounding to happen.
We dug into why failure is not just common, but often necessary, because outlier tales drive so many results. Why using money to buy control over your time might be at highest and best use, and that crucial difference between looking rich and actually being wealthy.
We looked at why focusing on your savings rate gives you more control than chasing uncertain returns, why aiming for reasonable often works better in real life than striving for pure rationality, and what lessons we can and maybe can't take from financial history.
And finally, why our brains seem wired for pessimism, but optimism tends to pay off long term. Why volatility is best viewed as a fee, not a fine. And the absolute necessity of knowing your own game and tuning out the noise from others playing different ones.
You also shared those insights about the historical context in the U.S., which adds another important layer.
Absolutely. Understanding that post-WWII, push for consumption, followed by decades where the economy grew more equitably.
Creating a certain set of expectations about a broad middle class and upward mobility.
Right. And then the shift, starting around the 1980s, where growth continued but became much more concentrated at the top, leading to rising inequality.
Which created that big stretch where the lifestyles of the increasingly wealthy inflated aspirations for everyone else whose incomes weren't keeping pace.
And how the existing culture of debt allowed people to bridge that gap by borrowing more, leading to soaring household debt.
And how subsequent policies often reinforced those trends. It helps explain why, for many people, the economy feels different today, maybe less fair or meritocratic than the narratives they grew up with.
Exactly. It's not necessarily a judgment, just acknowledging the historical shifts that shape current perceptions, and why expectations set in one era can feel mismatched with the reality of another. That history is sticky.
And bringing it right down to the personal level, that Sandy Gottsman question, what do you own and why, it really forces you to connect the dots between theory and your actual actions.
It does. And the author's personal example of prioritizing independence control over time above all else and achieving it through managing expectations and a high savings rate, not necessarily chasing the highest possible income.
It provides a concrete example of living these principles, keeping the lifestyle goalposts from moving too much.
Saving for the unknown, for those inevitable curveballs rather than just specific goals.
And choosing an investment strategy like simple index funds, not because it's guaranteed to be the absolute best, but because it's reasonable, sustainable, and gives the highest odds of meeting their specific goal of independence reliably, especially when combined with saving diligently.
It's a powerful case study in defining your own game and sticking to it, acknowledging it might not be the right game for everyone, but it's the right one for them.
So taking all of this in, this incredibly rich, nuanced picture of money psychology from the sources you provided.
From luck to compounding to behavior to history.
Thinking about all these interconnected ideas, here's where it gets really interesting for you, the listener. Considering everything we've just unpacked, What's the one single insight, story, or concept from this deep dive that really clicked for you?
What maybe shifts your perspective even slightly on how you manage your own finances, or perhaps how you view the financial world and the choices others make?
Something to mull over until our next deep dive.
Thanks for tuning in to the Book Summary Podcast. If you found value in today's episode, hit that like button, subscribe for more summaries, and share it with someone who's ready to grow. Want deeper insights, exclusive book notes, and reading tips? Join our free newsletter. The link's in the description. And don't forget, if you'd like to read the full book, our affiliate link is right below. It helps support the channel and keeps the summaries coming. Until next time, keep reading, keep growing.